Good morning, everybody. Thank you for your time, attention, and dedication to the alternative investment industry. We love to bring the industry leaders that are best of breed operators in their respective spaces. And we want to thank today's host and flyer members. Today's participating companies are Practical VC, EI Ventures, and Avacana. Let's just do a quick overview of today's events. First, we'll be starting with Practical Ventures. Then we'll have a fireside chat with David Nixad, Michael Corselli, hosted by Silly. We'll be doing another keynote, Disrupting the Global Pharmaceutical Industry with Cannabinoid-Based Medicines with Avacana. And we'll be doing an introduction of the flyer marketplace. With that being said, I want to introduce Aman Verjee, general partner at Practical Ventures Capital, was a high-ranking captain from the infamous PayPal Mafia. Aman, I'm going to hand it over to you and you can take it away.
All right, thank you. Wow, quite an introduction. Happy to be here, and hopefully this will be a lot of fun. Let me tell you just briefly about the firm. We have a couple of members, the old PayPal crew, as part of the firm. I joined in 2001, so that was before they were a public company, and I was on the finance and analytics side, and had a good long 10-year run there in different finance roles. Since then, I've been a CFO of a couple of later stage companies, and I'm now one of the two general partners of Practical Venture Capital. The other gentleman on the left side of the screen is Dave McClure. He and I also met at PayPal back around 2001. He was on the marketing side, but I was on the finance side, and together we run PVC along with their colleague Stephanie Shorter. I'll tell you a little bit more about some of the opportunities we're seeing as we go through, but let me start and just talk about the topic at hand, which is the private and public company valuations and how we got here, where we see the market, and then we'll talk about where we see some of the opportunities going forward. So when we talk about the market valuations in starting off with just the public markets, it's important to remember how we got here and what were the catalysts and the genesis for the current market that we're in. On this page, I've just shown two different slides which reflect the government of the US and their actions since March of 2020. They've really got two tools at their disposal, and both have been used during the pandemic and the recession that followed in what is an unprecedented way. On the left-hand side is the federal deficit as a percent of GDP. That essentially shows you the amount of fiscal stimulus that the government is putting to work, the amount of spending less the amount of taxes that they collect every year. And typically in the US, the federal government has run a deficit of around 3, 4, 5% of GDP in up and down markets. It's a little bit bigger when the market's down. It's a little bit better when the market is strong and the economy is growing. As recently as 1998, we actually had a balanced budget in the US. You can see that little black line in the last recession in 2009, it dipped quite a bit lower than it has ever dipped before, with the exception of World War II. The deficit in 2008, 2009 went to about 10% of GDP, and that was the fiscal stimulus response to the last recession. Well, this time around in 2020 and 21, the fiscal deficit opened up a lot more than it ever had, out to about 15, 16, almost 17% of GDP. So really an unprecedented fiscal stimulus that we haven't seen since World War II. On the right-hand side is the monetary stimulus. This graph shows you the amount of assets that the Federal Reserve holds on their balance sheet. Up until 2007, 2008, the Federal Reserve really didn't hold anything on their balance sheet. The only way they manipulated or controlled demand in the economy was by manipulating short-term interest rates. And that was it. And in 2008, they opened up a new tool in their toolkit by buying assets, buying up treasury securities, mortgage-backed securities, a little bit of corporate securities and debt. And by taking that onto their balance sheet and exchanging it for money, they essentially created and printed money and put that into the economy. They did a fair amount of that in 2008, 2009. That red bar shows you the months of the recession. So you can definitely see that as the recession happened, the Fed responded and put money into the economy. They did a whole lot more of that this time around. It was a much more abbreviated recession, but they put a whole lot of stimulus to work, and they've continued to print money long after the end of that recession. And together, these two policy measures have created a lot of demand side stimulus and a lot of money supply that just wasn't there before. So what was the result of that? We can debate whether the underlying economy is healthier as a result, and whether those policies worked in terms of just stabilizing the economy and creating a healthier output or a healthier economy in general. But what is certainly true is the prices of everything in the US just went haywire. What do I mean by that? On the left-hand side is the US inflation rate, which you can see on that blue line. Between about early 2021 and today, the inflation rate has skyrocketed from around 2.5% a year, which is traditionally where it's been and where the Fed wants it to be. Today, as of, I guess, yesterday, the last print was 9.1%. So the inflation rate is way higher than it was before the pandemic and is now sitting at a 40-year high. It's not just goods and services that have gotten more expensive. Look on the right-hand side, the average home price in the US, the price of Bitcoin, everything has started to go up into the right. And it started right or soon after that stimulus began in early 2020. So everything, assets, goods, services, everything has been increasing in terms of price at a very, very rapid and accelerating rate. There's also, let me just share with you a commodity index. You can look at commodities like gold or silver or copper or any kind of precious metal or virtually any hard asset. We were in kind of a commodities down cycle from around 2010, 2011 up until 2016, 2017. Prices of commodities were essentially going down in real terms. And then they stabilized. And now, beginning in 2020, everything began to go up. A lot of commodities are 2 to 3 times higher than they were at the start of the pandemic. So this whole money supply inflation by the government has created a stimulus in prices and inflated all kinds of financial assets and hard assets. More recently, the Fed's been talking about normalizing. And so here's how the markets have been reacting. You can see the major indices plotted here. The S&P 500 is down around 21% from its 52-week high. And that's now a bear market. The Russell 2000 smaller cap value index is down even more. And the growth stuff, the NASDAQ and the Russell 2000 growth index are down by 31 to 36% from their 52-week highs. So as the Fed's has been signaling and talking about slowing down this money supply growth or even reversing it, what's definitely happened is financial assets have dropped. The more growth-oriented assets have dropped much more quickly. Those with prospective cash flows way out in the future have been punished the most. And that's just been the result of the Fed talking about normalization. So if you think about now where the markets sit, like where do they sit in real terms? Are we expensive? Are we about right? Are we cheap? I would generally tend to argue that we're about right. Here's why I think that. There are a couple of measures you can use just to triangulate the market and see where we think we are. This one I like a lot. It's called a Shiller ratio. It's kind of a cyclically adjusted price earnings ratio. Basically, it takes the market cap of all the S&P 500 companies today, looks at their earnings over the last 10 years, adjusts that for inflation, and then just as a price earnings ratio and says, here's where we are relative to the historic, last 10 years. And the last 10 years is good because it's up cycles, down cycles, you get a strong economy, you get a weak economy. It's just a longer term trend in earnings. As we sit today, the S&P is around 29.9x Shiller ratio. That's a lot lower than it was a few months ago, where it peaked at 38. But it's still on the expensive side of where we have been in history. Over the last 50 years, the Shiller ratio has been around 21x, 22x. So it's still a little pricey given a historical pattern for earnings for the stock market. That said, you have to remember that interest rates are also lower than they historically have been. So if you look at where the long bond, the treasury bond has been over the last 50 years, for much of that period up until the early 2000s, it averaged around 6 or 7%. That's what the 30-year treasury bond averaged. Today, it's about 3% and change. So in a lower rate environment, you'd expect generally higher price earning ratios. So I'd say the S&P it doesn't look historically cheap on the surface. It's still a little bit expensive using historical benchmarks. However, in a lower rate environment, that's kind of what you'd expect. So we're not far from where we should be based on that measure. Second measure is, what does the S&P price earnings ratio look like today? So forget about the last 10 years and kind of an cyclically adjusted pattern earnings. Just what's the PE ratio of the S&P today? And historically, where does it sit compared to historical norms? Well, if you go back to 1870 or so, the average has been 16x. And if you look at the more recent period, just the last 5 or 10 years, it's been in the low 20s, 22 to 24x. And that's kind of where we are today. We're a little bit south of 20x, actually. And if the earnings on the index actually deliver to where people think they will, then that seems, again, right in line with, or maybe a little bit, maybe a little bit cheap relative to where we have been. Now, I caveat that a little bit because I'm not sure earnings will land exactly where people think, and so you have to think there's going to be some reduction as we go into the rest of the year on earnings forecasts. But given where we are, we don't seem to be far from that average 19, 20, 22x PE ratio. Here's another good measure of the stock market that I like, and I've been reading different takes on the Fed stock valuation model, which is something that a gentleman named Ed Yardney came up with a number of years ago. And he basically posited that, hey, the S&P 500 should have an earnings yield, a forward yield that looks a lot like what you get on corporate bonds. If you think about the yield that corporate bonds provide, like if I buy a company in the stock market and I look at the earnings and dividends that it pays, should that be all that different than its BBB corporate bond yield? In his theory, his answer was no. And if you look back at the last 20, 22 years, it turns out that this S&P 500 forward yield does look a lot like the BBB corporate bond yield. There have been times when they've become disconnected, and when that green line is the S&P 500 yield, when that goes above the red, which is the corporate bonds, typically that's a great time to buy stocks. And when it goes below the red line, that's usually not a very good time to buy stocks. And eventually those lines tend to get they run pretty close together. They don't always run together every month, and there are certainly periods where they get disconnected, but usually when they get disconnected, they come back in line. And it turns out that today, it looks like those red and green lines are almost right on top of each other. Meaning, if you were to buy the stock market and you look at the earnings yield, the earnings and dividends you get from the stock market, it's about the same as a BBB corporate bond yield, which kind of makes intuitive sense as a finance concept. Those two shouldn't be too far apart. So it doesn't seem like one of those is way out of whack anymore. There was a period for a while when the stock market looked expensive. Maybe the bonds looked a bit cheap, but it seems like that has now resolved itself. So I think that's kind of interesting. And that sort of tells me that I think we're seeing the stock market back to where it should be, in terms of the overall valuations. Let me skip a little bit ahead now and talk about SaaS companies and the tech sector. And then, we can talk a bit about the private alternative market and see where that is. We maintain an index of SaaS companies that are all publicly traded. And we look at the multiples of sales of those companies. And I've charted that back to Q1 13. Over the last, 5, 6, 7, 8 years, the average multiple has been around 8x. Like in Q1 of 18, it was 8x. In Q1 of 20, it was about 8.5x. Today, it's 8x. I look at that and I say, well, that seems about right. Like if I look back for the last, 5, 6, 7 years, does the market feel expensive or cheap today? It seems like it's, right where it has been. The kicker is that the last 2 years were a completely inflated time, right? When the multiples were up to 16, 17, 18x. So they went up way beyond anything we'd ever seen before and have now come crashing down. But in reality, we've just normalized. I think we have to, in your mind, you have to sort of eliminate the last 2 years from your mind. That was just a period of the economy when the Fed and the government had us hopped up on Red Bull and cocaine, and everything was just, through the roof. We had this huge asset inflation bubble across all these assets, SaaS companies included, and now we've just normalized. The category is performing great. Earnings growth has been strong. We're seeing a lot of traction on net retention revenue and EBITDA metrics. And there's nothing, even though we may be in a recession right now, the companies that have been reporting earnings have been doing great. So this seems largely like just a reset on pricing, but not something reflecting the underlying performance of the companies. Big question that I get all the time now is what's happening in private markets, and what's the relationship between these public market corrections and the private markets? It depends a lot on which part of the private markets you're playing in. We see two very different stories playing out right now, at least in the US, between the early stage stuff on the left, which is the kind of Series A and sort of C to Series A companies. And then the right-hand side is the Series D and above rounds, which are called the pre-IPO rounds. The left-hand chart just shows the average deal size of a round done in the US. I like deal size as opposed to valuation, just because when private companies report valuations, There can be preference structure. There can be just ways to manipulate and report evaluation that doesn't reflect the underlying nature of the deal. It's kind of hard to hide round size. Like if you're able to track round size and dilution of a company, that's just a very good, clean way to show if the companies are getting more or less valuable. On the left-hand side, that blue line represents the average round size of a company. And those red bars are recessions or NASDAQ corrections. When the NASDAQ goes down by 20% or more, what is the, what do the private markets do? Well, if you just focus on the left-hand side, you notice that there is a high correlation between the blue line and where the NASDAQ is. So private round sizes and valuations are highly correlated to the NASDAQ, but there's often a lag. Like in certain recessions, that blue line seems to hold on pretty strong and doesn't really give any ground, even though the public markets have been very robust. In fact, based on PitchBook's latest report, we haven't seen any drop right now in Series A valuations or round sizes. So the companies that are raising are still doing a good job of maintaining and defending their valuations and dilution through the second quarter. Very different story on the right-hand side, where you get the Series D companies, which are the pre-IPO companies. Usually when there's a NASDAQ correction, that blue line dips. In fact, I think it's done that virtually every time. And for sure, in the last couple of quarters, we've seen the Series D valuations drop by about 10 to maybe 15% now in Q2. So not quite as much as the NASDAQ, which is down by 30%, but definitely pressure and contraction on the round sizes for later stage companies and a little bit more acceptance, I think, of the reality. I think what's going to happen is as we get towards the end of the year, there will be a trickle down across the whole category. So the Series D and beyond rounds will keep dropping through the end of the year. The Series A companies will eventually start to course correct and maybe not as much, but come down towards where they were at this time last year, a little bit before. And that'll be a much better, buying opportunity if you are an investor and looking for the right kind of deal. As far as as far as advice on how to think about the market if you're an investor, remember this: a lot of the market for the last 18 months has been set by really two major crossover. We'll call them venture capital firms, but they really are private equity hedge fund shops, which have been leading between them almost a quarter of all the activity in the US. Tiger and SoftBank. Tiger and SoftBank have both said in the last 3 months, first of all, they've taken huge losses in their portfolio, huge write-downs. They have left certainly the later stage of the market and are scaling back their bets in a really, really big way. So I don't expect them to be price setting again, certainly not at last year's volume anytime soon. And that's going to put pressure on overall pricing for the category. They're not the only one. They're not the only VCs that have risk off and are leaving the ecosystem, but they are the two most prominent ones. And so I think what that's going to mean is a lot of better opportunities to be investing if you're a private market investor now. As far as how startups are raising, the general pattern of what we've been telling our companies and how to think about this is, look, if you need to raise, then you should go get the money. Just understand that your growth metrics, if you're a SaaS or an e-commerce company, have got to be in the awesome range. Like you've got to be able to demonstrate a lot of positive things to be able to raise at all. Probably not at the price that you want, but even to get a deal done in this environment, you better be in that left awesome category. What does an awesome company look like? Just a few of the key metrics I would look to is what is the growth in ARR? If it's 3x or better, that's awesome. If you're not growing at 2x year over year, that's going to be challenging to even get a deal done for your company. If your gross margins are above 70%, like they should be for software businesses, that's awesome. Below 50%, that's going to be challenging. If your net revenue retention rate's more than 140%, great. If you're like at 110% or less, it's going to be hard to raise money and prove your business model. And then LTV to CAC, if you're a 2-to-1 or better, your payback ratio is 6 months or better, great. If not, you should work on that. Fix that before you go out and raise, because you may not get a deal done if you can't hit that metric. And frankly, the valuation is going to suffer a lot if you can't hit that metric. All right, so I think that's about 20 minutes in. I've got about 10 left. I'd love to just pause maybe. And Jeremy, if you have any questions or anything you want to double click on, I'd love to hear what the audience has to say.
Absolutely. It's been a great presentation. So the obvious question is, from your experience, where do you think the market goes from here? I think what we have, I think if I just go back to the
the premise I had before was how do we get here, right? And where's the market now? And I think if I can kind of conclude the market is about rightly priced, not not too expensive, not too cheap. 20x PE ratio seems like it's in the US. That seems like it's not too far from where it should be. The rate that ratio going back to 1870 is like 16x. So you might look at that and say, wow, we're kind of expensive. We're not cheap yet. We're kind of expensive. Maybe there's some downside. But remember, interest rates are lower than they typically have been. So that seems to sink. I think the question now is what happens on interest rates, and are we over peak inflation? And every economist I talk to has a different opinion on whether we're at peak inflation or not. And everybody keeps getting surprised. I think we are close to peak inflation, and here's kind of why. I think this is the reasons for inflation fundamentally have been debated and discussed. Let me just find the slide here. I think the most important thing to look at when you're thinking about inflation is what is the money supply in the country doing? There are a lot of reasons why prices are high, right? Oil prices are high. There's a gas shock. There's a war in the Ukraine. We're running out of food. We're running out of commodities. There's a labor supply shortage. Like every microeconomist I talk to has a different perspective on why inflation is high and potentially still rising. But the macroeconomists, I think, would just look at it and say, well, basically, we increased the money supply by a lot beginning in March of 2020. We began printing money. What did we think was going to happen? Obviously, every time you print money, you create inflation. That's been the story for at least 9 of these cycles going back to the 1800s. So why was this time any different? And it turns out it wasn't. Like in March of 2020, the money supply growth went from 5, 6, 7% year over year into the 25% year over year growth area for months and months and months on end. And it took a while, but the inflation rate has begun to creep up. That's the blue line is the money supply growth, and the orange line is the CPI. In the last couple of months, the money supply has actually been shrinking. Like the Fed they've been talking tough, they've been raising interest rates, but most importantly, they've been controlling and constricting the money supply. For the first time, actually, I think since the Great Depression, and I've been studying this a lot, I don't think I've ever seen a shrinking money supply in the US. The last time that happened, I think, was in 1929, maybe 1933. And we have a shrinking money supply right now in the US, and it's been like that for 2 months in a row. So I think the Fed is, they're talking tough, they're acting tough. I do feel like inflation's going to stabilize and come back down. I guarantee you we're not going to have runaway hyperinflation. We're not Argentina. It's just a matter of time. Whether it takes time for inflation to stabilize, and whether it's this month or next month or towards the end of the year, that's harder to predict. But I think we're heading in the right direction, and I think then rates will stabilize where they are, and then I think we'll be set up for a decent rally here in the here in the US.
Okay, Alim wants to know, we may be close to peak inflation, but it will still take some rate rises to ensure that disinflation commences and continues. What happens to your valuation / premise if 10-year rates go to 5%?
Yeah, I'm not going to argue with Alim because he is much more experienced in the world of banking and finance and economics than I am, or than your typical viewer. But I think he's right. I think if there is a reduction in, let's say that inflation doesn't throttle as quickly as I might think, and it lingers, and then you get another series of rate rises where the Fed starts to increase rates up to 5% or 6%. And then the long bond begins to drift back up to 5 or 6% in sympathy. Then I think a 20 PE ratio is probably aggressive. I think now we're talking about low teens or maybe mid-teens, which is kind of where we were for much of the 1980s, as an example. That's exactly where we were. We had the Fed long bond somewhere in the 5 to 6 to maybe 7% range. We had short-term rates in the 4 to 5% range. And for much of that period, we were seeing 10, 12, 14 PE ratios. And it's entirely possible that there's another leg down in the market in order to correct for that. If inflation continues to persist, if we can't get on top of those inflation expectations, that's certainly a possibility. I think the probability of that scenario coming out is like a 30% probability, and therefore a bit more maybe in the bullish camp of that. I don't think it's going to end up being that bad, but it's certainly a major possibility as we move forward.
Okay, we got about 4 minutes left. So if you have a question, send it in now, but we have some others. What
Yeah,
is your portfolio mix of companies by domicile and sector?
yeah. Yeah, I think our so let me talk a bit about our fund, what we've done. We essentially are a secondary fund. So we are going out and identifying funds that are performing well, that we like, that we think will do well in this environment that we're in. Meaning they're still growing. We can get them at a good price, at a discount to the kind of last round that they did. And even if the market drops by another 30%, we want to make money. So we're trying to buy discounts of 30 to 70%. Not, when I say discount, I don't mean 5%, 10% off. I mean 30 to 70% off. So a deep discount off that last round. And the company's got to be great, growing, profitable, net revenue retention where we wanted, all those awesome metrics that I described on the other side. Given that, I think we're seeing a lot of opportunities in the US, and they're becoming better and better and better. So as we go more and more into the year, I think we're seeing more sellers willing to sell. It's probably about 2/3 of our companies and funds are in the US, and 1/3 are outside of the US right now. I'm in London right now. We're looking at Europe as a possibility. We've been very active in Latin America and Southeast Asia. Just kind of avoiding China for right now for a variety of reasons, but trying to be pretty active and opportunistic around the world. Just right now, I think the US is going to offer us some really good opportunities, and so that's going to be close to 2/3 of our fund.
Are you seeing any good deals with the euro weakness? Does that make European companies more attractive?
Yeah, in theory. I'm about to head to France tomorrow. And actually, for the first time in 20 years, it seems like the dollar and the euro are at parity, which is amazing. So that's going to make traveling in Europe a lot of fun. With the dollar so the dollar strength is probably helping by 10 to 20%. That might give us a little bit of advantage. I don't know that we're seeing these 30 to 70% discounts right now in European domiciles, but we're definitely exploring and looking. I think in theory, the stronger US dollar is going to give us a little bit of a shopping advantage for sure. So that's one of the factors at play, but not the biggest one. It's still going to come down to growth and valuation and multiple. And so the currency, arbitrage is kind of a minor assist, not a major factor.
A strong dollar is usually bad for U.S. companies that export, but how does it affect SaaS companies?
A strong dollar, it would the SaaS companies and software companies don't produce anything. First of all, they're not dependent on inputs, so they're relatively unaffected on the input side. I think on the demand side, all else being equal, the stronger dollar will depress European sales or sales denominated in non-US currencies. But software companies typically price for that, so they will adjust pricing based on the competitive dynamic of the market and make up for it. So I'd say it's a typically a non-factor for software or SaaS companies.
Okay, so we got 1 minute left. Is there anything you want to cover, and why don't you to let everybody know how to contact you guys?
Yeah, when do that? So I gave you here are the members of the team. You can send us any of us an email. Dave is dave@practicalvc.com. I am Aman at practicalvc.com, and Steph is steph@practicalvc.com. So we try to keep it simple.
I got one quick more question, which is, can SaaS companies generally pass along cost inflation, salaries, et cetera, or are their margins getting hit in the current environment?
That's a great question. The short answer is SaaS companies, the ones that we like that are doing well or have gross margins of 70% or more. And because of that, they are able to pass on most of their, most, if not all of their cost increases. In fact, salary increases are a factor, and every SaaS company that has people in the Bay Area or New York, I guess, or London, knows what a pain in the ass it is to pay 6, 7, 8, 9, 10% salary increases. But so many of them now are sourcing talent from abroad, from India, and from Latin America and from Eastern Europe. And so the strong dollar actually makes it better to source talent from there and cheaper to source talent from there in the US dollar. So I think they have a huge advantage actually as we go into a strong dollar environment or a recessionary environment. They actually are much better able to protect their margins than most companies can pass along those very slight cost increases. And I think they'll be a great source of strength and growth going forward for the US economy.
All right, Aman, great job as always. I'm going to hand it over to Michael and David at this point, but thank you
Great.
again.
Very good. Thank you.